All right. Thank you, the panelists, for participating. We will start with introductions. Please introduce yourself, your firm. Please be brief because we will be diving into specifics of how you invest in the panel. So we'll start with Denise.
Hi, I'm Denise Logan. I'm the Seller Whisperer. And if you're wondering what that is, I do the emotional support work to keep the people and the deals from falling apart. I know none of you have ever seen that where a deal has fallen apart because of emotion. I come to the process, my background is I was a mental health professional and then a lawyer. And I watched deals unravel for all the reasons that were not being said. So you can find me at deniselogan.com, and I wrote a book about the emotion involved in a deal called The Seller's Journey.
Thank you, Denise. Tim, please introduce yourself and your firm.
Good morning. My name is Tim Lewis. I'm a partner at Southfield. We're an investment firm based in Greenwich, Connecticut. We have two strategies. We have a private equity fund where I spend most of my time, and we also have a mezzanine fund. We focus on lower middle market companies, business services companies on the PE side, and industry agnostic on the mezzanine side. Looking forward to participating in the panel and select interviews or discussions rather with execs later this afternoon. Thank you.
Thank you.
You lost your picture, Yelena.
Yeah, I lost. Yeah, I'm reconnecting. I'm sorry. So we'll go to. Oh, here you go. Now I can see everybody. So we go to Zachary. Please introduce yourself.
Thanks, Yelena. Yeah, so Zach Nemes. I'm with Aves Capital Management. Recently formed, coming out of Victory Park Capital, which is a $3 billion asset manager based here in Chicago. We're the successor fund for all things special situations that Victory Park historically has done. We look to invest anywhere from $20 to $75 million, typically in non-control situations, usually sort of middle of the capital structure, sub-debt or preferred equity in complicated situations. Focus on consumer, retail, and business services in North America. So interested to learn a little bit more about the various executives here and share some insight from us.
Zach, maybe you can just give us a little bit more information on what you consider special situation.
Yeah, historically it meant distress, deep value, bankruptcy transactions. I'd say we're shying away from that a little bit, but would still explore, various restructurings or distress situations. It's more company-specific challenges, companies experiencing some stress, some lender fatigue. A lot of what's going on right now with COVID as sort of a catalyst requiring some capital, or maybe there'd be situations where an entrepreneur is looking to exit, but now it's not the right time to take the company to market, and so looking to take some capital off the table, and we can come in with an alternative financing, an alternative to a change of control transaction at potentially depressed values, or situations where there's an over-levered balance sheet. We can come in with a little bit more of an equity mindset with either sub-debt or structured equity to solve a capital need. And so there's some form of complexity, company or industry or secular that may be happening that we could be helpful with.
Sounds good. Thank you. Chris?
Hi, my name's Chris Brown. I'm with Montage Partners. We're a private equity group out of Scottsdale, Arizona. We've been around about 16 years, always investing into the lower middle market. So our target profile for companies, we don't do any kind of distressed or turnaround type stuff, no startup stuff or anything like that. So really just established companies that have been around a bit. What may be a little bit different than us than some of the others on the panel is that we'll go down market a bit. So our target criteria for a new platform is anywhere from 1 to 5 million of EBITDA. So a bit lower than some of these other groups. We may, ultimately exit to some of these other groups, but beyond that, we're looking for a lot of the same things as other folks: sustainable competitive positions, consistency in customer relationships, high revenue retention, consistent margins, stable cash flow profiles, and we'll also invest across a variety of industries. We've done investments in business services, consumer health, or industrial technology. We look at healthcare deals. So a lot of different things we'd be willing to invest in, and that's kind of the high level on us.
Thank you, Kelsey.
Hi, yeah, my name is Kelsey Lozier. I'm with Silver Oak Services Partners. We're a PE fund based in Chicago. We've been around for 15 years. Last year actually raised our fourth fund, and that one was $500 million. Typically spend time between kind of that 4 to 25 million EBITDA range, but like many of the people on this call, we're kind of focused on that, still on the lower end of the middle market. So a lot of our platforms start out kind of that 4 to 10 million EBITDA range, and we'd like to grow them, from 4 to 10, hopefully, or higher. Yeah, we're all services focused, so it's business, healthcare, and consumer. So if you look at our portfolio, it's super broad. We have, janitorial services, fitness, a lot of healthcare providers, too, dental providers, physical therapy, and then the way we grow the businesses is kind of, a combination of organic, de novo, and M&A growth, and it just kind of depends on the investment, and so we can get more into that later. But yeah, thanks for having me today, and it's my first Blackmore conference, so look forward to it.
Yeah, thank you. Thank you for participating. So the panel title is Debunking the Private Equity Myth, and one of the myths is that private equity at best will just buy a company and just hold it for a little bit and then flip it for a higher price, and the worst of it is ruin the business. So I'd like to pose this question: what is the reason for your firm to exist? What exactly do you do with companies? Why you're in this business? So Kelsey, I'll start with you. You alluded a little bit about growth. So maybe you can tell us a little bit more what exactly you see as your purpose of your company.
Yeah, sure. So again, every situation's different, but if you look at our portfolio, it's pretty broad, but then a lot of these companies have similar underlying characteristics. And for us, a lot of them are kind of poised for growth, we'd say, for whatever reason. Whether it's just industry dynamics or, this owner's really ramping up. And typically for us, a way we differentiate is, we're a source of capital for an owner, typically these founder-owned businesses that, they're to a point in their growth cycle where they just feel like they don't want to take any more balance sheet risk, where they see maybe, 3 add-on acquisitions, in that same region, or, they want to, diversify their product or service offering or whatever it might be to kind of accelerate that growth, but they just don't want to take that personal risk. So we're a good alternative. A lot of our deals might be kind of a 60-40% structure, 70-30. So we're still giving that owner a really good opportunity to roll a decent amount of their equity and participate in significant upside. And we always say we know our role as investors, so we're not super operationally focused where we come in and we act like we know the space. We know kind of our expertise in accelerating that growth and professionalizing these businesses and helping where we can, but we're not going to
how?
Hey. What was that?
How do you accelerate the growth? What exactly, if you're not involved in the operation?
Yeah, so we're not, I guess it's not that we're not involved, but we're not coming in and saying, hey, we have more expertise in, let's say, home healthcare than this operator that's been in the business for 25 years. We're not stepping in and saying, hey, move out of our way. We're the private equity firm involved now. We're partnering with them. That's why we say Silver Oak Services Partners. We're partnering with them to accelerate growth, create a strategy, whatever that is. So again, an example is a fitness business we have in our portfolio. That one's grown, through de novo. So we've been adding new locations, started at 17, now we're around 50. So that's a really good growth story for us. Other deals have done maybe, 20 add-ons in the past where, we've accelerated M&A growth. And so maybe that's, people at Silver Oak doing those add-ons. Exactly. And so
M&A is one of the...
Go ahead, sorry.
Oh, yeah, go ahead.
I was just going to say it's more so kind of, we're working with the management teams to figure out what that growth strategy is, and kind of using our resources and our expertise to kind of help them grow, and also be a capital source for them as well, with resources, obviously. So.
And what a typical interaction between your team and the management team would look like? The frequency of it, the intensity of it, maybe some specific scenarios where you get involved, like M&A.
Yeah, it just depends. Again, so we have a dental roll up that we've started on in Fund 3, and that one was originally called Redwood Dental, and we recently changed the name to Smile Partners due to their growth. And again, so we brought in more of a development team, and now they actually have different regions because they grew from Detroit to Atlanta and added a new region. So we'll, hire salespeople internally to kind of help that strategy. And again, that one is growing through smaller add-ons. So instead of, finding something that might be in an auction process through a banker that's highly competitive, maybe a 5 or 10 million EBITDA to double the size of the business, we've taken an approach to do kind of smaller, maybe $500,000 EBITDA add-ons or $1 million add-ons. And those VPs of business development at the portfolio company level are kind of executing at that granular level, and then we're working with them. And so again, we might participate in an auction process that's 5 million EBITDA at Silver Oak, but those smaller add-ons, we're kind of working with the management team to kind of grow, at the portfolio company level. So that would be an example of one. But then there's others where, we might double. We have a business called Legacy Farms. It's a produce distributor. Sorry, and that one started. It was over 100 million top line, that base business, and then we combined it with a competitor nearby in that region. Again, that one was over 100 million top line. So we kind of put together two larger companies, and that one required a little bit more detail right at Silver Oak because of just the size and scale of that add-on. So I think it just depends.
Thank you. Thank you very much. So we'll go to Chris. So you mentioned that you focus on companies with EBITDA from 1 to 5. So this is maybe below your typical private equity criteria. So what is the purpose there?
Yeah, so it's a few things. One, oftentimes there's just a little bit less competition down there. So, a lot of the groups you've heard today, their platforms may start at 4 or 5 million of EBITDA. So, if you're willing to go look at a company that's 2 or 3 million, there's going to be a bit less competition in that market. It's less efficient, so there's opportunities to find a good deal there. The other thing that's interesting there is a funny thing kind of happens with companies as they reach right around that size. It's kind of a mix of what I'll call real companies with real systems, real processes, KPIs, those type of things. And also these companies that are just more entrepreneurial in nature. They're maybe led by the initial founder. They've been doing things the same way for 40 years under that founder. And so a lot of times there's opportunity for a group like ours to kind of come in and professionalize the business a bit, maybe add in some of those systems and processes and things like that, and start doing things in a more efficient and scalable way that can help the business grow, and also just prepares it for additional growth for maybe that next group that we'll exit to. Maybe we'll exit to one of the other groups on this conference today. But so there's some unique attributes in that into the market that lead themselves to good investments, and it's a spot that we've had some success in.
This sounds good. As you know, one of the things that people say about private equity, that investor comes in and fires people or over leverage the company. Is it even possible in your segment, in a small company? How do you approach people and leverage, or other things that might be maybe available to a large investor in large companies?
Yeah, so I think it's a few things. I think when we come into a company, I'd almost argue it's just the opposite. Oftentimes these companies in the end of the market we work in, they don't have a fully built out management team. Maybe they don't have a sales team, or they don't have a financial executive or something like that. So oftentimes when we're coming in, we're quickly trying to fill some of those gaps and holes. Another place that we're helpful is that we've tried to, or we're building internally here at Montage Partners, a bit of, I'll call it a shared services offering. So with companies of that size, they don't necessarily have the scale to have, say, a full-time marketing resource on staff or a whatever it may be. So what we're working to do is build some of those resources here internally that then can be shared amongst some of our portfolio companies. So if they need help with a press release or something like that, at that point we can get involved and be helpful. But those are just kind of a couple of things that we do there.
Yes, sounds wonderful. Thank you. Zach, you already told us your kind of your focus area. How do you, what you do, how does it really affect, maybe segments, market segments that are experiencing difficulties? So maybe you have an example that you're working on right now in the COVID-19 kind of context or another context. So to debunk the myth that private equity investors are always looking to just buy and flip and not create much value.
Yeah, no. So we get involved a fair bit. Historically, have gotten involved a fair bit in the operations of businesses. Try to upgrade where possible specific roles and engage recruiters that perhaps the prior management team may not, from a recruiting standpoint, to find the right folks to lead parts of the organization. We're obviously able to provide some additional capital, and typically when we're legging into a given deal, recapitalize the balance sheet to position the company a little bit better than it may have been previously, to focus on that growth and keep as much cash in the system. We try to avoid over leveraged situations day one, to provide that flexibility for management. And so not too often that we're getting involved in those sort of tougher situations where there's just not enough cash flow. And if that's the case, then we make sure that we reserve enough dry powder for that growth. And we like to partner with management teams. And so on the entrepreneur side, we're typically getting involved in situations where the first institutional capital is in there and providing a sounding board for those folks to kind of plan out the next handful of years of growth, potentially bring on some independent board members to help scale the organization, folks with outside experience that are sort of a consultant and motivated with some of the equity through an equity incentive plan at the board level. And so a variety of ways that we try to influence the course of the business and provide some additional oversight and assistance wherever possible. And then on the flip side, situation, sorry, go ahead.
Oh, you go ahead.
Yeah, in other situations where we're getting involved, where there's an existing sponsor and they may be tapped out, it's out of an older fund, or they may not have any additional capital to put into the business, and now is not the right time to sell. And so it provides that liquidity or capital for XYZ acquisition or CapEx initiative that helps further scale the organization and position it for a sell, in a few years' time. So those are, I guess, a handful of ways.
I wanted to ask who's involved in what kind of decisions, or how much is your firm involved in decisions, and what kind? At what point you may even take the control? Maybe you can give us some examples there.
Yeah, so we're typically at the board level, so monthly calls with management to go through financial reporting and any updates on strategy or major initiatives to the extent needed, talking on a weekly or bi-weekly basis with key members of management around anything that needs sort of a closer touch. Otherwise, at a quarterly basis, having board meetings and discussions similar to a lot of our peers in the space. And so try to be as involved as we need to, but not get in management shorts if we don't have to be.
Mm-hmm.
Elena, when you have a moment, there's a question from the audience when you think it's the right time.
Yeah, please, go ahead. Yeah, go ahead.
Okay, Mark Snyder, let's call on Mark Snyder, please. Go ahead and please do video. Thank you.
Good afternoon. This is obviously a fairly serious issue since we have a seller whisperer on the panel. There are, in my experience, a lot of hurdles surrounding the seller's emotional state throughout the process. How do you guys manage that? How do you get involved with that aspect of the deal, or don't you? I've seen a lot of deals fall apart simply over emotional stress with the seller. And very often it's not real. So you guys are talking about all the things that you do versus, you know, the myth, if you will, but it's still going to be prevalent. There's still going to be emotional, whether it's with private equity or not. And, you know, how do you engage in that process?
Denise, would you like to take this question?
Thanks. I'm going to send you along with me, Mark. You're like my straight man to tee that up. We do see that this is an emotional process for our sellers. For them, this is a transition. It is definitely not a transaction. And so the more we're able to step in and build trust, I think one of the things I hear often in the industry is that we consider ourselves to be trusted advisors. But the key word there is trusted. And to be able to build trust means building a long-term relationship. So one of the things I would suggest to the executives who are on the call today is to recognize that when you are out prospecting for each of your sellers, this is about building a long-term relationship with them. It's not, I wrote a column a while ago called, "It's the R in your CRM that matters to your C." And so realistically, this is about building a long-term relationship so that that owner trusts you. On the flip side, it's the same thing with the private equity firms who are on the call today. As an executive, building a relationship with them, not making this be a single drop-in, as if I've got a deal for you. Can you take my deal? If not, I'm out of here. So when I think about something like our call today, it's really about thinking, if I'm going to be in contact with each of the owners I'm chasing and each of the private equity members on this call, how would I deepen that over the course of a year or 2 years? Not what can I get from today's call? And we heard a couple of things in some of the questions that have come in so far. I think Jay asked a question in the first panel, which was what to do when we can't be in person. And there's a lot to do to build a relationship, even while we're not in person. So that's the opportunity where every call you have with them, every outreach you have, can be an opportunity to deepen into what you know about them, not just what you know about their business. Because there are moments that are natural when the
personally, are you talking about family and personal interests?
Absolutely. And right now, I think one of the great parts about if this is a silver lining of our coronavirus experience, is that we are having a lot of Zoom calls, and we're having the opportunity to almost be in each other's homes that we wouldn't otherwise get. So I just want to think about one moment when our seller is terrified. There are lots of them, but certainly when they think about private equity is going to come in and rip my company apart. Another time is when we first poke at financials, our seller is filled with shame. And I will often say to an owner, you're going to feel shame when we poke at financials. And they'll say, I don't have anything to be ashamed of. And I'll remind them, feeling shame and being ashamed are not the same. So one of the things we can do is normalize the emotional process that they're going to experience. And Gerald and I have done at least 2, maybe 3 webinars on the topics of how to become more emotionally present with your owners and how to deepen those connections. If you haven't seen them, they're worth going back. And if you have, probably
yes. If they haven't, you can just ask me for it, and I'll get it. Well, actually, I'll make sure you, Denise, that everyone who is part of the conference gets that. Okay.
Yeah, and I think Chris tagged on something too, that a founder might have spent 40 years For them, this is an identity shift, even more than the money. So one of the things we can focus on is whenever, I always say it's never about what it looks like it's about. So if an owner is acting squirrely, you can bet that it is not about whatever they're talking about. And you'll see in that webinar, I go through a couple of different examples. And Kelsey, you and I didn't do this transaction together, but I did a dental transition recently. And those owners had been together for 35 years. It was the longest stable adult relationship that they had, and separating those two partners from each other at the time there was a transition was huge. We often see that, I could tell you lots more stories, but that gives a good example. And the way the seller's journey is written is it's written as a business fable. It's the story of an owner 1 year after he successfully sells his company. And he goes on a trip across Glacier National Park with his banker, his lawyer, his wealth manager, and the private equity buyer who bought his firm. I wrote it that way so that as they're crossing the glacier, they relate the physical obstacles of crossing the glacier to the emotional obstacles that the owner faced. And it's a tool for you to be able to use to help your owner get language around what's happening for them so they can tell you.
Thank you, Denise. So any other questions before I go to Tim? No. Tim, so the same question to you as before. What's the purpose of your firm? How you treat your investments? Again, the myth is private equity ruins companies, fires people, makes all the wrong decisions and so forth. Please tell us.
So, I don't think the Southfield approach is wildly different than what Zach and Chris and Kelsey have described, for the simple reason that we're all focusing on lower middle market businesses, and the lower middle market.
And why is that? Mm-hmm.
Why are we focusing on lower middle market?
Why is it different for lower middle market versus larger companies?
The lower middle market businesses, typically the kind of businesses that I imagine we're all focusing on, were certainly the ones that Southfield is focusing on. They do a couple things really well. I mean, the entrepreneur wouldn't be selling to a private equity firm if the business didn't have some scale to it, impressive growth trajectory, good financial performance, solid team. But at the lower middle market, typically there are going to be lots of gaps as well. Parts of the business that are relatively immature compared to other aspects of the business, a thin team, pretty limited on a system standpoint and formal process standpoint, most likely no ability to do acquisitions independent of someone supporting them. So even though the business is impressive and attractive to the private equity buyer, it doesn't mean that it's a year or two away from being a sellable business for the buyer. Typically, you're looking at at least 3 to 5 years, if not more, to implement the kind of value creation strategies that a lower middle market investor is going to implement. It just takes time. And then, even if you've got a pretty good plan, my experience is that you're always sort of encountering a surprise. You get punched in the nose, just regardless of the level and quality of diligence you do. And when those surprises or those events occur, you may have to take a step to the side and slow down some of the initiatives that you're working on, or maybe even take a detour and go down a different path. So it's I think unrealistic. It's actually unrealistic to expect that a lower middle market investment is going to be a 18-month, 2-year turn. I think much more realistically, I think when you're talking to, as these execs are talking to owners who may be private equity, potentially private equity businesses down the road. I think more realistically talks to them about long time horizons,
Mm-hmm.
5, 6, 7 years, and prepare them for what that means and what their role would look like as it evolves during that time period.
And Tim, how do you speak about that with the owner who maybe spent 20 years and was able, was running the company and only was able to grow it to 5 million EBITDA, and now you're saying within 5 to 7 years we want to grow to 10 million EBITDA. So how do you sort of give the owner the conviction that it's possible? What kind of specific assistance beyond capital do you typically provide?
Well, we're going to tell that owner that we want to get their business to 15 to 25 million of EBITDA, not 10 million of EBITDA. So we're actually going to have loftier goals for the business. I don't think it's, again, I don't think it's terribly different than what Kelsey was outlining earlier. The typical investment that Southfield makes is going to have two sort of primary, growth areas. One is organic growth, and the other is acquisition growth. There are instances where the acquisition growth is a more modest part of the growth strategy, but that's not typical for a Southfield investment. The businesses that we're investing in, we always want them to have good growth, historically, and the opportunity for even faster growth going forward. But to achieve what we want to accomplish, it typically requires some acquisition as well. You're trying to diversify their customer base, so maybe acquiring a business that's in a different industry sector, maybe create, you want to have a broader geographic platform, you want to add a complementary service, you just want more scale. There are reasons why, even if you have solid organic growth and a good strategy for driving organic growth, you're still going to want to lean on acquisitions as part of your investment strategy. And frankly, we're looking for, I think as the other panelists have described, we're looking for someone to work with us, to collaborate with us. We want them to be as excited about that end game as we are. So, we're going to describe different ways that we could work with them, some ideas that we have around the investment strategy before, during the diligence process. So we're all sort of starting to align and get excited, and there's enthusiasm about what we're going to do after the close, so that when we hit the ground running post-close, we're more or less in alignment and driving to the same goal. If we don't, if we encounter an entrepreneur who's not excited and then it's probably not the right deal for us.
Yeah, that's the point I wanted to make, is that alignment is important. I had a number of experiences where the owner would get actually scared when I start talking about doubling, tripling, quadrupling the business, or even just asking a question, how fast can you grow this business? That's, I guess you answered that question. It has to be really the alignment, but also it's so new for some owners. I mean, that kind of appetite for growth, especially if they believe private equity myths, right? So they might be just requiring some time to adjust, or maybe they are scared. Denise, maybe you can share with us some maybe examples you had or some ideas on how to kind of maybe through a relationship to create that alignment that might not exist to begin with, or understand if that alignment can be created.
Sure, thanks, Yelena. One of the things that we see is that for an owner, their business has often become their identity. I see there's a question over in the chat box that I'm just going to tag on because I think this is relevant. Whether we're dealing with a young owner or an older owner, there are things that are happening in their psyche that we need to be conscious of. Things like they're getting something from their business other than just money. So we often focus on how much they're going to earn. A question that you can ask every owner early on when you're starting to meet with them is, what does work provide for you? And we should be able to get somewhere between 10 and 12 different answers to that question. So obviously money is one piece, but it's also, for those of us who are stuck at home with our spouses, it's a dang place to go during the day to get away from our spouses. It's also a place where many of our owners get friendship or connection or power. Those are the things that later on will start showing up in a deal and unravel it. So an example is I was working on a transaction with a young owner. He was in his mid-30s, and he was going to net $16 million on the other side of the deal. And at one point he realized, wait, who am I going to hang out with after I sell my company? And so he said that to his best friend. They were out, hanging out. And his friend said, boo-hoo, dude. I wish I had your sad little $16 million problem. And we might feel like that about them, but the reality is that problem doesn't go away. It just went underground and started acting out in the deal, where suddenly he was pulling back. Another thing that's going on often in our deals is there's an attachment element that goes on. Our owners are both attached to their business and attached to us as advisors. So if you just draw a little line on your paper with 3 different points, the center point we'll call the anchor, the far left point call the island, and the far right point called the wave. Those are attachment styles, and what we can see is that for someone who is an anchor attachment, they're able to ride out a certain amount of too close or too far. Our island attachment people, if someone gets too close or they get disturbed, they will leave. Literally, they retreat to their island. And you might be thinking as you're hearing that, oh, I've seen that happen in a deal. That's your owner who starts ghosting you. A wave attachment style is someone who, whenever there's anxiety or upset, they're going to come closer. They're going to do things like, are we okay? Are we okay? Are we okay? They'll be texting you, blowing up your phone, calling you.
So the first thing is to recognize the type of personality, right? Quickly.
The personality you are and the personality they are. Because for those of us who are advisors, we are often waves. So that when our client pulls away, we tend to chase them. And when we chase them, we send them further to their island. We send them more emails. We call them. Or if we tend to be someone who is more island-like, when an owner starts blowing up our phone or worrying us, what we'll do is distance from them. That's a very simple thing about knowing who you are and who your client is and how you're wired that can tone down a ton of the chaos that goes on in a deal.
That sounds good. All right. Do we have any questions, Gerald, or should I go to another topic?
Let me just check. I think there's one new one that just came in.
Is it from Bill?
No new questions. No. Bill Bryan.
Okay.
Let's go to Bill Bryan.
Yes. Good morning, everyone. And Denise, thanks for your comments on highlighting that question. I was just curious from all the panelists, do you see, I'll call it the art of the deal and the people's outlook really be different between, I'll call it the young entrepreneur, AKA millennial, versus, the experienced owner that's been, toiling at their business for 20 plus years, AKA maybe Gen X or baby boomer? Thanks.
Who would like, Chris, maybe it's something you can answer because some of your companies are quite small. Maybe you have a mix of entrepreneur of a startup versus a 25 kind of year-old company.
Yeah, sure. Obviously, everything here would be, heavily generalized. Everybody's a little bit different. You might have some, baby boomer owners that are more like a millennial or vice versa. But I would say, generally speaking, those sellers that are, in that baby boomer generation, they're, 65-ish or something like that. A lot of times their business is turned into a lifestyle business. Maybe they're working full time, maybe they're not. But a lot of those guys and gals aren't necessarily in it for 50, 60 hours a week, and they're not necessarily all that interested in chasing growth. They're really looking for a partner that can take over for them, maybe provide them a succession plan, maybe bring in a successor, something like that to fill the needs for their business. The needs from the younger founder that's 35 or 40 years old, a lot of times for them, it's, hey, I've built this company to a certain scale that I'm not comfortable taking it to the next level. So I want a partner to help me do that. Maybe I need some more resources to help me do that. Still a lot of fire in the belly to grow. And so that maybe that kind of attitude and what their goals are in a transaction, generally speaking, is maybe one of the big differences I've noticed.
If I may add to that, I wouldn't be surprised to see many commonalities. At least I have in my experience. And one of these commonalities Chris mentioned is that the owners, whether of a startup or an older company, they realize they can't really take it to the next level and they need help. So that's that you can see in actually many cases. Anybody else would like to add? All right. So the next topic, the next myth about private equity is that
4 minutes.
Is that
4 minutes.
That the investor wants to steal the company, so underpay and or put conditions or terms that would somehow make the initial maybe promised purchase price smaller. It's absolutely true that there is a asymmetry of information or knowledge. Private equity investors know much more about deal structures and contracts than the seller. So that's, in my experience, a real can be a real obstacle because it creates suspicion between the seller and the buyer. So I'm wondering how you see it, overcome it, maybe prevent it. I'll start with you. Maybe you can tell us an example from your experience.
Yeah, I mean, I think, that's kind of where the role of the investment banker a lot of times comes into play, especially on the sell side. I think, these owners have an opportunity if they are kind of bringing their deal to market in more of an auction process. They have an opportunity to choose their own advisor who they trust and who can kind of, represent them in a way that, they are able to help them kind of do what's best for their future and for the company, and kind of help them make that decision on, there's so many aspects to a deal, right? It's, like you said, the personalities, how you partner. I mean, what's the structure? Some people want, more of a 60-40 or 70-30 deal. Others want to do 100% exit. And so I think it's so situation specific. It's tough, but I think that's where the role of that investment banker comes in, that they really trust, or someone like Denise, where they can kind of, work with her and talk to her about kind of what the offer looks like, and kind of, look at market comps or whatever it is that gets them comfortable with the value. Obviously, a lot of sellers too, it's, they always think their company might be worth a lot more than what it is, just because of how much passion they have about the company, right? So that's something that private equity also struggles with. So I think having an intermediary in a lot of these situations is so important. And, even sometimes, you'll have two intermediaries a lot of times too, right? So it just depends. I mean, a lot of times we have a buy side advisor calling on our behalf, right? But a lot of times these owners, if they're being contacted directly by us, they want an opinion, and so they'll bring someone in on their side. And I think that's a great idea, just to make sure that as much direct contact with the private equity fund is, although we love it, right? I mean, it's great for us. It's good to have an advisor in there from a seller standpoint. So
yeah, thank you. Chris, I wonder if you have maybe different experience. I understand you're looking for targets outside of maybe auction? Do you get involved with them in structure discussions and where you can see that anxieties of, kind of zero-sum game anxiety, I call them?
Yeah, I mean, I think the biggest thing that we do to try to relieve some of that is, I think, just being transparent and upfront from kind of day one. So, delivering on what you say you're going to do, even stuff as simple as you say, hey, I'm going to get you over a request list by the end of the day. Make sure you do that. If you're consistently delivering on what you say you're going to do, and that you're transparent with what you need and how you're kind of viewing something or whatever that may be. And it doesn't mean that, you just open the kimono and show all your cards or anything like that, but you've got to be upfront and honest and, deliver on whatever expectations you set. And by doing that over the course of a deal, I mean, we all know a deal takes, 6+ months to get to the finish line. And maybe you've been talking to this owner even for a while before that. Over the course of all that time, eventually you're going to be able to hopefully build that trust and rapport. So.
Sounds good. Anybody else would like to add to this question? I guess not.
Okay, that's
Jill,
it. End of the panel.
Oh,
We're going to take a 10-minute break. Be back in 9 minutes. 9 minutes break. Okay, thank you.